Hello everyone, my name is Nadia Mansour. I am a doctor in finance from Tunisia. I am very honored to present my working paper entitled Prudential Regulation and Stability Banking in Tunisia, a DSGE model, in your prestigious conference. The plan of my presentation is composed of 8 parts. We will start with an introduction, problematic, research questions and objectives. Subsequently, the methodology and the model, and at the end, the conclusion. So, during the past decade, the development of the financial system has created different types of activities and financial instruments. In this context, developments in the financial sector seem to have played an important role in the configuration and sometimes the amplification of macroeconomic fluctuations. Consequential concerns in excessive variability in the financial system have highlighted the need to put in place measures for prudential regulation, accounting and risk measurement or monetary policy with the goal of consolidating the financial system and macroeconomic stability. This diagram presents the evolution of prudential regulation. Basel I appeared in July 1988 with the principle of minimum capital requirement. In June 1999, Basel Committee announced Basel II with 3 pillars, Pillar 1, minimum capital requirement, Pillar 2, prudential supervision, Pillar 3, market discipline. In December 2000, Basel III appeared the aim of reinforcing the 3 pillars of Basel II and in particular Pillar 1. Therefore, and with financial liberalization, developing countries cannot stay safe from these risks. However, few studies have focused on the study of the relationship between banking regulation in Tunisia. Although it has many characteristics with regard to the fragility of the banking system and informational opacity of the financial markets, as well as its need to integrate on the international market. So, the problem developed is to analyze the impact of banking regulation in Tunisia on the management of banking risks, financial and macroeconomic stability. For the research questions, what is the impact of banking regulation on the management of banking risk? And what is the impact of banking regulation on financial and macroeconomic stability? The objectives are to present the determinants of banking risk and financial stability in Tunisia between 2003 and 2017 with dynamic stochastic general equilibrium (DSGE). The model captures the role played by prudential regulations in correcting fluctuations in the business cycle and restoring macroeconomic and financial stability. We will now go to the theoretical foundations. Financial stability refers to a bank's ability to withstand significant shocks and the resolution of macroeconomic imbalances, thereby reducing the probability of a break in the financial intermediation between savings and investment. So, financial stability requires 2 main conditions. It is important that the main institutions of the financial system are stable so that there is sufficient confidence to continue to fulfill their contractual obligations without necessarily having external assistance or interruption. And the main markets must be stable so that each actor can trade with confidence at prices reflecting the fundamental data on the market. For the methodology, the sample is composed of 17 commercial banks in Tunisia between 2003 and 2017. For the database, is composed by accounting variables from bank scope and macroeconomic variables from World Bank. The econometric method is the dynamic stochastic equilibrium general using MATLAB software. The DSGE model is a new Keynesian model with small open economy. It is based on the work of Alimi, Chakroun and research 2017, Abdelli and Belhaj 2015, Falagherida and Sayer 2017. The model composed by 4 economic agents: monetary authority, commercial bank, firms and households. For the households, households work and save to finance their current and future consumption for final goods. The economy in this model is formed by a unitary set of household index by J0.1, whose problem is to maximize a particular intertemporal welfare function. Preferences of a representative household are defined by habitual consumption C, holding of real balances, and leisure. Household preferences are described by the following utility function. The firm sector is presented in a standard way. Each firm produces and sells goods and services in a monopolistically market with a perfect competition. The production function is a standard called Douglas, where alpha is the part of capital used in the productive process, while T is the product. Phi is a fixed cost, which means that profits are zero in the steady state and it represents productivity. The demand function faced by each firm J is, the profit function for each firm J is, Kim, 2000. Financial institutions use equity in bank deposits to produce loans according to the following technology. Lieutenant, the credit supply, the technology adopted by the banking industry. DT, the demand for deposits. Feet, the bank's own financial capital. Sigma E, 0, 1, the participation of deposits in the production of loans. For the monetary authority, the central bank is in charge of providing liquidity to the financial system when it becomes necessary. The instrument is a rule of financial stabilization, which follows a simplified version of McCallum, 1994, where greater than 0, a parameter that defines the central bank commitment with financial stability, the deviations from interest rate on deposits to the steady state rate. In this study we used 3 shock: technology, monetary and liquidity. For the data and estimation of the model presented above will be estimated by Bayesian methods. The data used a quarterly series of the following for the period from 2000 Q1 to 2017 Q4, including CPI inflation, GDP at constant prices, and nominal interest rate. So to conclude, the major aim of this paper was to estimate the central bank preferences using a DSGE model for a small open economy to evaluate the Tunisian monetary policy during the last decade, in particular for the post-revolution period, and to criticize the inability of the Central Bank of Tunisia to stabilize the economy. Thank you for your attention.